Good afternoon, everybody. I'm Dan Hussey with Zaner, Hedge, bringing you our strategy of the week update here for August 10th, 2023. Remember, trading futures involves risk and is not suitable for all investors. And everything we talk about here today is just my own opinion and not a direct trade recommendation. We'll begin the discussion with row crops, corn, wheat, beans. Corn and wheat, really not much to update us on the charts here since last week. It's kind of sad when you go an entire week worth of trading. Not just 5 days. I mean like week, full on week here, without any real price action to speak of. But it is what it is, right? And maybe that's a signal into tomorrow's report for that the market is waiting to hear something from the USDA, to whether or not it's what the USDA has to say, or maybe it's just a matter of getting this report out of the way so that we can get back to trading other mechanisms, people with algorithms that are turned off, for example, until something, changes or gives them a reason to trade again. The WASD numbers, I think generally speaking, I know the trade, and certainly we're looking for reductions in corn ending stocks for new crop, soybeans to the tune of 30 million, 100 million off of corn ending stocks, 160 off the corn ending stock number. But generally speaking, those yield numbers are where the reductions are likely coming from, right? 174 and a half is our expectation for the corn yield. That's down from 177 and a half, and on soybeans here down another half point to 51 and a half from 52. Obviously there can be a case made, and we'll get into the charts here in a minute, but there can be a case, I think, made here for some late year rains that have really changed the outlook for yield potential this year. Certainly turned it around from a 2012 like crop loss or yield expectation. But is this, full on 1992 variant that our chief market strategist, Ted Seifert, over here pointed out a lot of correlations a few months ago between volcanic activity in 92 that caused this, and an El Nino turning year, in fact, that caused this late year weather pattern shift from very dry drought-like conditions into rainy, wet, and mild, which is, I think, how many places could describe some of that rain for a little period. Now, that doesn't mean, right, we are out of the woodwork in terms of the damage that was done, even in the places that got rain, right, because there are still places that didn't. But places like Western Iowa, for example, will they be able to make up for some of that lost yield potential in others? That's the national average yield game, right, that gets played. So we're going to be really looking forward to see what they do on the demand side tomorrow. They've stayed strong on corn demand in a balance sheet where they added, 700 to 800 million million bushels, of domestic demand year over year compared to last year. If that stays on the balance sheet, gets bigger, that could, I don't see them increasing it per se, but hey, we've seen some pretty good export numbers as of late, right? Things are steady. We've seen flash sales too. That's always good to see, and certainly from a headline demand perspective can turn things up. But the charts have been unbelievably lackluster. Let's begin with the daily chart of corn here. I've got December corn up. We're below all of our major moving averages. The corn chart should flop over here. There we go. 18-day moving average is still above us, up at that 523 area. I see, an open gap on this corn chart, basically up there around that 526 to 530 area, where we gapped down 2 weeks ago. We have left that gap open. We've settled back down inside of this very tight trading range. Can't really break above $5. Can't break below $4.90 either. And we find ourselves just listing sideways. We are in oversold conditions on the daily RSI. So, I mean, the fact that we're down into the low end of the range and oversold conditions, okay, will Friday's report be the thing that breaks the camel's back? That'll send corn, diving lower to 460, 440, 420. I think, 450 is on the minds of a lot of traders. If we go below $5, these nice round levels. But, there's really not much in the way of open interest that has, any that has anything attached to anything below, this 480 area. And that's that July low that we saw in December corn. 100-day and 55-day moving average are getting close to each other, still in, their bearish kind of 55 below the 100 here, around the 530 area, and the 200-day moving average was resistance there into the end of July, up at 566 and a half currently. So kind of carves out, I think, the idea that we could be coming in formulating some kind of low end of the range, and mean reversion, I think, would still take you back to 530 on December corn. So, my game plan with a lot of traders has been, building into perhaps some call spreads right now to pre-plan some reownership, or get some reownership structured here, with the idea, though, that you can roll that call spread lower, buy back the short call if we're wrong, right? If we break down to 460 or 440 corn, a 620 or 640 call, that maybe $6 call that you were selling to buy the 520 call or something, will have lost its value, and you can buy that back at a profit. Now, the long call has lost value too, but you can use at least the profits against the short call to roll that one down, perhaps improve your strike if it makes sense to, right? There's management you can do there, and a call spread is a way of putting, a trade into the market that doesn't have the same confidence as a long futures position. Now, not to say we can't be confident with a long futures or short futures position in any market, so long as you define risk and have a stop, right? But the risk of buying futures here at 496, if you wanted to be a buyer, and putting a stop, at 487 below the lows here, or at 480 below, the July low, they're very defined risk levels, right, to use, and that's very good for a trading plan, right? But I think going into a report tomorrow, we have a high risk of the market, just selling off real quick and bouncing if it wanted to clear the book, so to speak, and run those stops and capitulate below that 480 summertime low. Now, if it finds, a similar seasonal pattern to last year, we would have expected the market to have been rallying a little bit here, and to have maybe caught a bid and traded back towards, $5.80 to $6 perhaps, or into this report or around it. That's not what's happening. It's very different in a sense that we've been in this very bearish price pattern, caught in a little bear flag and putting a lot of pressure on support. That kind of feels like the path of least resistance will be to the downside to clear out any, of anyone who has stops or is, managing risk against this 480 area. Now, that brings me to an idea for, risk management into next week. I was actually just looking at this with some clients into the close, with the idea that how do we protect ourselves, into next week for corn. These are new crop options. Okay, so I was looking at 1 week here in December corn. The 490. We settled at 496. This 490 put was going between 6.5 to 7 cents there into the close. The idea being, for 7 cents, you could have got long a 490 put, had a floor in on December corn at 490 through next Friday, so not tomorrow, but the following Friday, for a through a report. Kind of not so different than having a stop down at there at 480 or something. Actually 483 if you wanted to do the math on it, by having, where actually your actual protection kicks in. But if we were, on the number to spike down there and then rally, you're not caught in a short futures position by using a put like this as a way of having risk protection. If we were to fall apart and go down to 450 and stay there, you're going to be very happy that you own a 490 put, right? So even if you're a bull in corn, or want to buy corn for that matter, using these end of week options that go off the end of next week, right? Or you could even look as aggressive as the ones that go off in the same day as the report if you really just want 1 day worth of protection into a news event. Well, this is how I would beseech you to do so, right? Is these end of week new crop options that really do have a utility in a trade risk management and a trade plan. Okay. They're a different way of getting that risk management exposure, right, than using a stop or for a long side position. And again, any of this can apply to being short the market and using a call as your risk management strategy. Or if you want the limited risk of owning corn, it looked like for about 4 cents going into the end of tomorrow, you can own the $5 call to see if we go much higher on this report tomorrow. That's what to me seems like well, it doesn't seem like it is a safer strategy than buying futures with the limited risk there. Okay, so like I said, there's really not much else that we can discuss. Unfortunately for corn, it's been, hey, that was an interesting way of getting some protection on. But when you look at this 4-hour chart in the smaller time frame, there isn't much to talk about in this short covering. Full 50% short from the 572 highs of July down to the lows of August now. Aligns with that open gap up around 530 in the 531 area. So I would love to see the market get up there. I think there should be a rally to do so. But we're clearly not, the market is obviously clearly putting up a fight here. And there's a big, supportive level below us that we should and probably need to consider here before anything else here, right? Anyway, moving on, because I think there'll be more to say about corn after the report tomorrow. Wheat. Chicago wheat futures here, and keep in mind we're looking for new crop ending stocks for wheat to maybe be increased and bumped up a little bit. We're guessing around 600 million there. On the global balance sheet too, that would that would likely result in a little bump up, by about a million metric tons or so to 267. We'll see what they want to do, but there's a lot of headlines out about wheat right now. India potentially removing the import tariffs. I know they've banned pretty much exports for that matter, and they're limiting and starting to dump their state reserves on domestic markets to try to keep prices down. I mean, that just to me means India is going to be gobbling up wheat again to replace the state reserves. They're going to probably start trying to import, and I don't think Asia they're notorious, just Asia in general is notorious for underestimating its own food demand and needs from the domestic balance sheet. Or, the other way of saying that is it's in their best interest to hide it, right? Because they need to buy and to feed billions of people. They want the cheapest prices possible. So it is what, China, India, and any other, really any food importing nation is going to be in their best interest to keep food prices down. So I think that's the start now of a trend we're going to see for both beans and rice, actually, for that matter, of domestic stockpiles being liquidated on open markets. And I think China, you're going to see a similar game being played here, because they have the stockpiles to do so. And plus, they don't want to store forever, right? There's liability in that storage. It can get ruined. You might as well use it or lose it and replace it. Especially if prices are cheap, and they feel that way. Chicago wheat here kind of in that same bear flag below all of our moving averages. I see no reason why we can't hold this low end of the range, still in oversold territory. But if we break down again, it's just a market that's continuing lower, and it's hard to fight that on the charts. Back above 660 in Chicago wheat and back towards our moving averages, we'd have a lot more to say, but there's not much to say. KC wheat's kind of the same difference here, way down here inside our larger trading range and expanding range we've been in. Below 750 here and below these lows, we're down into uncharted territory again. So you can't underestimate wheat's ability to break down, even though I do think we're down to the low end of the range that we should hold and maybe bounce from. With September wheat actually the one that's holding kind of a bit of a trend line here. A little shocked myself that we broke below that 18-day moving average, but nevertheless, wheat is wheat. So it couldn't fight its brethren that wanted to go down, even though a lot of the fundamentals and everything I know about spring wheat right now seem like it shouldn't be as bearish as it is. But let's also not forget we were darn near $9 crop there for a bit. So it's not like we haven't had decent prices to sell the wheat here, generally speaking, and certainly comparatively to the last few years. Not, last year in the market run up during a war included, but hey, those headlines may come back, and I feel like wheat got a little maybe used to that type of activity, and it's looking for those types of headlines again to do that again, and it just, when it doesn't get them, it just gets sold off, right? What do they say? You want to be a rich man, sell wheat? Well, I feel like that age-old saying is ringing true. Which brings us to the daily chart of soybeans. Let's just get right into it, because there's a lot more to say here. We know crop and balance sheets are what they are, and if we're looking for them to tighten up in the ending stock number, and with the yields to tighten up as well, production, Zaner's guess is coming in here at 4.259 billion bushels compared to 4.3 from the prior USDA settlement or settlement issued WASD. Beans have a stronger case, right? I think for one, a continued weather market now, and two, for really strong demand perhaps into the fourth quarter. We've seen China week over week here come through in that new crop sales in the exports. I mean, last week's was one of the biggest since 2020, if not the biggest. Saw good exports, strong exports continue this week, and let's face it, we've been seeing flash sales too. So there's definitely a demand, story happening for soybeans. We're also, in the depths of August weather markets. We get hot and dry for the rest of August. We could stunt some of that pod filling that we are hoping really could continue, through here. But we have a good weather for the next couple of weeks. We could really, really, really add to that bottom line where, late in the year where it was rather unexpected in June, right? But I think the market in the near term has spoken a few times. One, the whole month of May and into June, we spent below $13 and we rallied back above here into June. June, we pulled back to test below 13 and hurried up through July back to highs. Well, here into August, we're testing 13 again, and it seems to be holding, right? This is the third day now of higher highs. Well, today was technically an outside day because we started a little lower, but generally speaking, green and higher highs here, continuing the trend higher. November beans 1333, though, is the full 200-day moving average. Kind of resistance now on the way back up. 18-day moving average is still well above us there at 1363, so I'd like to see us get a little higher reversion in the mean. We were pulling out of oversold territory down here in the daily RSI for Novi beans, but it seems to have settled just below the levels to kind of get there. So I still think there should be some more upside here to unwind that a little bit. And we got news tomorrow to see if it'll happen. Support came in here at the 102 55-day moving averages down there, 100-day at 1289 and the 55-day, that green line at 1301. We're above those levels now. It's good to see. And there is a 50% retracement here from 1130 that we'll look at on the 4-hour chart up to the highs here from July that traded to the penny there at 1382. And we will take a look at that bounce and how it's kind of performing here. But, it gives me technical reasons to think that soybeans could be basing and building into something bigger. And that bigger could be a push towards 15 to 16. But just in the near term, if we're going to stay above 13, we don't need to break out of 1440 all that much for, ideas like 1320 or 1340 calls. Owning those and then selling, the 1420 or 1440 against it, you can still get almost 4-to-1 risk reward ratio. In other words, a 25-cent cost is what I'm looking for a dollar-wide spread. So you can make, a raw 75 cents of profit if you're totally right and the market goes way, way higher. But these are all ideas, right, to help structure re-ownership so that you can have confidence in doing sales when we do start to head higher that maybe you haven't done yet. Or that you can do the sales now, right, and have that, re-owned up $1 or more. I mean, we can look at plenty together, for open upside. All right, so new crop beans here, 4-hour chart, open gap up at 1382. Okay, we gapped lower on Sunday open. Left that 1382 gap open 2 weeks ago and it sold off. I also see another intraday open gap here at the 1330. We basically came up to try to fill that here today. Where we held support, I think we could get another run at that level. If we do, it constitutes a breakout that should target the highs of the month at 1354, and ultimately that 1380 to 1382 gap fill will be up next. Full 50% retracement off the highs. Sorry, let me grab the right tool here. From highs to lows after. is at 1358. So this isn't a level I would necessarily look to be a personal seller or speculative seller in, but hey, if you want to be, that would be kind of the next area of resistance to the upside. It's more of these are levels now for me that I'm looking for the market to target to confirm that upside bias that we have, because we're building into multiple degrees now, in my opinion, of reasons to think support on soybeans is holding, whether it's trend lines, moving averages, 50% retracements, and even the balance sheets say, hey, we are still tight on beans. And unless we get that gangbuster weather that starts the narrative of going to a 52 to 54 national average for production, then there's no point in talking about anything that's, over 300 million bushel carryout, which I think is still on the high side given what we're seeing on demand. So if that's the case and we push down to the 200 million bushel carryout because we dropped from a 52 bushel an acre national average that the USDA was originally telling us down to a 51, 50, or God forbid a 49 or 48, now all of a sudden we're talking sub 200, sub 100 million bushel carryout. There's no reason beans should be anything sub 15 at that point, in my humble opinion, based off of what we saw last year as well. So that stock to usage ratio tightening up, I think, is another notion that we need to continue to follow. The weather narrative this year, we definitely can swing that, and you can see if you just running the balance sheets on the, the numbers on the what if scenarios in the balance sheet, you can see that 49 to 54 range that we're probably going to fall in. Give yourself some room on either side for national average on soybeans. It really makes or breaks pipeline, the idea of being at pipeline. So with that being said, that 4-hour chart from the 1130 swing low there, and now the kind of the low on the recent charts here for November beans up to the 1435 highs of July, pull back into 1282 to the penny trades and holds. We then kind of go up and break above the short-term trend line here today, and even in the near term as we start to dial down into the 15-minute chart here. The market already kind of pulled back into maybe 2 steps forward, 1 step back. Even today, today's price action from the lows of the day to the highs after pulled into a 50%. I wouldn't be so interested in that 16 to 13, 14 area if, we hadn't broken, maybe above some downward sloping trend lines. And, I could consider this a pullback into, broken support, now resistance. And now we've got a pattern of higher highs and higher lows. Now we've got a pattern of the market building into 50% fibs. We've got a pattern of breaking where we would think resistance would be and filling gaps above. It's a good reason to think a bottom could be forming. Of course, getting back above this 1320 to 1315 area, that's a big, retaking the old lows from the month of July, the supportive area that we had for the first couple weeks of August that broke. And it would be, to me, would show this 1282 low as, a bit of capitulation as the market is now starting to trade higher. So I'm, fairly sufficed. I'm feeling a little bullish on the beans here because of what we're seeing building on the charts, the fundamentals we could see come out of tomorrow's report. It has me interested to think that soybeans, have a good reason to think we could continue higher. Maybe the path of least resistance is up to fill some levels. Can't rule out, a slide down to retest big supportive levels, of course. And, I think we're breaking, again, you take a step back on that daily chart, we've broken above some old levels and retaken some levels that are important. And sliding back down below them would be significant as well. So we can't rule that out. But for the time being, soybeans look like they're building it into something here, in my opinion. And we'll see if that continues. Real quick, and some of the other oil seeds here, bean oil has been very strong, and I think this August contract really kind of starting to pay attention to September, flagging up here is good. But if they break down, the 62 level, reversion to the mean and testing the 5,500 and 200-day moving averages that are well below us, probably going to be in the works. I'm a little worried because canola oil is now making lower lows and lower highs, breaking below and making a new low for the month into this 200-day moving average. We slip. I think we're coming down to the 740 to 720 area, test its bigger levels. And if we, look at September here, palm oil, kind of failing to get back above that 200-day moving average. It's holding the 55-day, but if we break below, I think room on this chart a little lower. So veg oils I'm a little worried about, in the near term, but we'll see what happens. Cattle, I would love to say I have more to report on in cattle other than just a continued uptrend in a market that's fighting in a range now. Bullish above 180, bearish below 185, or bearish below 185, 180, excuse me. Bullish above, bearish below 180 on the October live cow. Let's put it that way. I think we do start to roll over. We're trying to find some resistance, but until we really roll over, it's hard to call this anything but trend continuation and a bit of a bull flag happening on the chart. There's definitely a downward sloping trend line now against these highs, and while we're below that line, I think we could put pressure on support and potentially see some capitulation. Watch that 55-day moving average for first support here down at 177. But I do think a move all the way down to 172 to 170 isn't out of the question here for the October live cattle yet again if they decide to slip. But you got August feeders still looking strong, holding above their 18-day moving average now. Excuse me. Same difference, but I had the August hogs up. But August feeders here, you can see the 18-day moving average at 246. I was wondering why that price did not compute in my head, right? But we're above that 200 or 18-day moving average, excuse me, there still. Slipping back below that level, next support 241. I think we could reopen down to this kind of inflection zone around the 230 handle. I just think we're still not in overbought conditions on these daily charts, surprisingly for cattle, which leaves room to the upside. But these trends are just so overdone. It's just going for so long. But box beef cut out strong. Demand is there. This is what inflation looks like. And if we're getting used to much higher prices in cattle, it kind of looks like we're about to break out, right? If we break out of these levels in the cattle, there's nothing but air above and just basically, trend channels to follow. So 185 would probably be next here for the August lives. With, the 260 area for feeders. Jeez. It's incredible, these moves we're seeing. Big discrepancy here between the August lean hogs and the October. October broke today by 1.25. August holding up above the 18 days. So they're really squeezing that into the end of the life for the August. So at some point I feel October is going to be a buy, but it's a bit of a falling knife here, at least falling back into the 255, and 100-day moving averages here around that 80 figure. Kind of watching it here myself now, finally oversold on the daily RSI, but we'll see. That's going to take some time, I think, to unwind a little bit here. And last and not least here, but in our agricultural products, before I move on to some crude and some other things to wrap up today's Strategy of the Week webinar. This big triangle sideways price action in cotton, I'm optimistic now that we're starting to break above, hold that 18-day moving average, and actually start really trending higher for cotton. So bullish above, bearish below that 18-day moving average, now at 85. If we break below that, I think we could come down to 80 and fall back in the larger range we've been in. But this market to me seems like we're trying to hold some trend lines, break above downward sloping trend lines, pull back, hold those as support before now pushing higher. I think 90 to 95 to the upside will be now the next kind of objective for cotton in the December contract to get to and back to the high end of the range. I'd love to see it go much higher and totally bust out of this very big sideways price action. We're going to be seeing, if it's going to be one of those rallies, we're going to watch, like in the past here, where it holds above that 18-day moving average and just kind of goes and goes and goes for a couple months. If that's the start of the trend cycle we're seeing, then, again, that 18-day moving average at 85 is very important now that we kind of stay above here in the near term. And lows of today holding in this breakout could, in my opinion, means that we're probably starting something like that. So optimistic here. Cotton's finally registering, the heat and the production here we've seen. Plus, demand out of Asia as well, potentially picking up. We shall see what happens into the end of this year. But to help our row crops somewhat, crude oil starting to break perhaps above some key resistance here at that 82 to 84 area. Some resistance for basically all of 2023 so far. take a step back on that daily chart, you can kind of see my idea here from the COVID lows to the highs after. We've pulled back into the big 50% area and around 68. This is also, area of inflection in the past where some resistance into 68, resistance into 75, into 80 that we broke out of with that big inflationary push with the invasion of the Ukraine. And then, subsequent pullback to test that area now as support. The U.S. has started buying and ideally would start replenishing our strategic oil reserves, as they said, down below 70, blah, blah, blah. Whether or not they're doing it, that's another story. But, okay, there's a reason to believe that the market should maybe find support here. It does. It seems like it's, spent its time consolidating sideways before breaking above trendline resistance. And now we're finding ourselves in a bit of a trend channel higher. In the near term, I think that trend channel should continue, maybe even lead to subsequent breakouts to big levels above. But I think we're on our way to testing towards that 90-95 downward sloping trend line and that other inflection zone, right? The supportive area through most of 2022 before we broke below it there in the third and fourth quarter of 2022 and started the downtrend that we've otherwise been in since then. That I think, arguably is starting to give way, and now we're going the other way. Can't rule out bigger pullbacks right down towards the supportive area of 80. That has been the start of this month's rally. And then I think even a bigger pullback to test some of these old monthly highs or down to 76 to 74 can't totally be ruled out in that crude. But the 4-hour chart, watching this trend channel kind of play out, as long as you're above that trend line, the trend line support of this channel, I think we're generally trying to chew through resistance and find our way higher for crude oil now in what has been a trend higher for the last couple weeks. So go crude. I think there's some anticipation for higher interest rates here in the near term from the metal markets. Gold really unable to break above 2,000 here, rolling back over. Okay, probably coming back down for another test of 1,900. We know there's a bigger pullback that could happen towards the 1850 area, and that unfortunately gold's really been this 2100 to 1600 range, and maybe that range is going to kind of continue to play out for the next year or two or something before another real round of inflation occurs, or the reason that gold should go to $3,000, right? There will be that reason at some point. Are we in the uptrend that takes us there? Perhaps, but this consolidation in this, sideways price action below 2,000 isn't making me feel very convincing that gold wants to get there in a hurry. If we were to hold support here, hold above 1,900, go back to 2,000, start breaking above it, that's a different story, because we can also make an argument that we are still basing up here, right, and building for maybe that move. So you can't rule all that out, but generally speaking, the trend since the midsummer time frame when our last FOMC meeting started to do victory laps on inflation, but still citing the need to hike interest rates. I think gold is maybe acknowledging that to some extent, and the wet blanket maybe has been thrown on the inflationary fire somewhat. But you look at risk appetite in like the S&P, we're holding in pullbacks into 50% retracements around this 44.91 area. It's also this old resistance here from the end of, I guess that was the end of June there, that we broke out of in July. August did a pullback, so in the near term above, 4,500 seems like the supportive area they're trying to hold. There's certainly some gaps on the chart below us, interestingly enough, that I'm sure we'll fill at some point. And if we take a step back and kind of look at what I was looking for after this breakout and start to break above 4,000 back in January this year, once that occurred, right, we flipped, we started drawing up the full 50% retracement longs. They were holding, they've gone to targets. We're holding the continuation extension levels in these pullbacks. In other words, the pullbacks that occur that then lead to new highs instead of, big, the ones that then become very big drawdowns. At some point, I do think we're going to get that break and pullback to 4,200 to maybe even 4,000 to test another, the full 50% retracement from the 3,500. October of 2022 lows to the highs after. Test the full 50 back of that whole swing, test the old breakout levels around 4,200 that we were consolidating below for the first half of 2023 that we finally broken above. At some point, we'll come back to test those levels, but we're still holding, in my opinion, supportive levels and pullbacks that are suggesting, continuation higher towards 4,700, 4,650 at this time in the S&P. And you can see those levels in the chart, right? Swing lows to highs. There's some extensions here too at 4,400 still. That could be, supportive, but we'll see, right? Bigger swing though, and a bigger break back to 4,200 at some point. I'm just not ready to call it underway yet, right? I'm not ready to say I think it's happening, but it could be. It could be on its way. It could be happening because support is support until it's not, and we are starting to dip below 4,500, which is a psychological level, and that risk appetite could, unwind a little bit. So, all right, well, we'll see how tomorrow's price action unfolds here for the row crops and in our WASD announcement. We'll, of course, I'll be trying to do a video or something, post-mortem on the trade or the news, and of course to kind of discuss how these markets played out in that regard. You can always get in touch with me over here at 312-277-00 or 0110, excuse me, number on the screen there. Find me on social media, and of course use the links in the sign up video of this video in the information section of this video to sign up for our free daily call with our chief market strategist, Ted Seifried. It's a really great way of getting a short, concise, 5-minute window of opportunity to hear what he has to say every day about the markets, and updated, of course, with real news and as real time permits. So have a great day, everybody. Thanks for joining me at this week's Strategy of the Week webinar, and we will be back with you tomorrow and as price action develops. Take care, everyone.